So again, we're leaving this slide now with trading personality defined and a sound understanding of major fundamental drivers. It's off to the charts. But before we go to the charts, I want to talk about the fundamentals that happened in quarter three. Okay. So technical analysis, just some basics on technical analysis. Again, I just want you to see this slide. I'm not going to go into detail because we're going to do it when we go into our review and preview. But 3 words: trend, support, and resistance. Understand those 3 things. I think that you'll be trading in decent locations. The trend's your friend, buy at support, sell at resistance. Do not play in the middle. And now you can build trading plans with chart-based reasons for entry, technical stops, and technical targets, all using the charts. So combine trading personality, combine fundamental analysis, combine technical analysis, and you have a trading plan with predefined risk to reward. Quarter 3 review. What happened in the past quarter? Fundamentally, a lot happened. The economic data around the world is slowing. It is really, really, really poor. No matter what region of the world you have, it is poor. So intervention has been the theme. Okay. So with that, what are the equity markets doing? Because we'll get into the technicals in just a moment. So the equity markets are responding very positively to it. So as long as the Federal Reserve and the central banks around the world are saying, we're here for you, and if things continue to get worse, we're still here for you, that's what I mean by QE does not have to end. Austerity measures, liquidity, quantitative easing, accommodative policy, whatever you want to call it, they do not have to end. The central banks can continue to intervene. That is not great for us as traders, but we have to be aware of it. So technically, what's going on with this? All right. What is QE? What does a rising equity market mean for trading ranges? We'll be able to look at this through the volatility gauge. Then we'll start to go into intermarket analysis. So no matter when I'm talking or writing, I'm always talking about intermarket analysis and ancillary markets. And that's obviously what the one day, one topic will go into a little bit more detail next week. We'll look at trends. Are there any? And ranges, are they intact or breaking down? So let's go back and review what's gone on in July, August, and September, which was quarter 3. So I'm going to start out, while this comes up, we're going to start out with just a quick look at the equity markets first, okay? And again, what I want you to focus on first, this chart that I'm going to blow up, is VIX. This is a volatility gauge, and this is a long-term chart of the volatility gauge. This is when the markets were crashing in 2007, 8, and early 2009. And then the markets recovered in late 2009, all of 2010, and 2011, and so far in 2012. So in the middle of the summer, we had a hiccup in 2010, volatility increased. In the middle of the summer in 2011, we had a hiccup. Kind of Greece was like kind of exploding last summer, if you remember, and volatility increased. Greece also kind of exploded this summer, even maybe more so than last summer, but volatility did pick up, but it's much less so. So overall, you can see that volatility is going down for the most part. And it's down here right now on its lows down here. So volatility, the number of people having an opinion and going in and having conviction one way or the other is getting less and less and less. So just so you know, volatility is down. That is going to affect trading ranges. Just on the opposite side of that, just so you can see what the stock market is doing, this is what S&P is doing over the same time frame. I'll put it out on a weekly time frame. So here we are. 2009 we rallied. 2010 we had a little bit of dip and then we rallied. 2011 we rallied and went sideways, a little bit of a dip and then rallied late in the year. 2012 we started rallying, had a bit of a dip, and now we're rallying. So the equity markets, as of a few weeks ago, is basically the highest it's been in the past 4 years. So the equity markets are going to the moon in response to intervention, and volatility is going down in response to an equity market that is saying everything's great, no fear, no uncertainty, no anxiety. Now we have to find out what that means for our Forex markets. Now that you have a view of the equity market's volatility, and volatility you can relate to trading ranges. What does it mean for the frequency of trading and how much am I trading? So there's your quarterly picture. If I can shrink this down for you just to see the past quarter, here's your quarterly picture. Here is July, August, and September, the markets were going up. If we can look at the volatility gauge during the same time frame, July, August, and September, let me shrink this down. Okay, we have July, August, it peaked up a little bit and then right back down to its lows in September. All right, so volatility did go down, back down towards its support level. And you can see, I talked about support. Where are they buying the VIX? Where do they think the stock market's overbought and the VIX, the fear gauge, is too low? Well, they're buying the VIX down right around 1330, 1340. Okay, that's factual data. That's not a guarantee that's going to happen in the future, but that's a factual data based on previous performance that every time it's gotten to 1353, let's say, they bought the VIX up. All right. So if you're an equity trader and you want to go long the VIX, or if you're an option trader and you want to buy calls down there, that's obviously the play. If you're looking to hedge your equity portfolio, then obviously that's your play. Does it go up a lot? No, but that's why you use trading plans. How much has it gone up in the past? And you start to build in. And if you can make 3%, 5%, 8% in an equity trade, if you can make 5%, 20%, 50% in an option trade, I think you're doing pretty well. Remember, make it realistic given what the markets are doing.